Today we're getting into something pretty fundamental in finance, variable interest rates.
Yeah, they pop up everywhere, don't they?
They really do. Yeah. And we've gotten some really interesting material from you all about getting a handle on financial health, especially when loans and particularly mortgages are on your mind.
Yeah, that's a big one for a lot of people.
So let's jump right into a key concept here, the total debt service ratio, or TDS as it's often called, right?
TDS, it's a really crucial number lenders use, especially for mortgages, it seems. So today we're going to really break down what it is, how it works, and frankly, why you should care about it.
Definitely. The sources you sent gave a pretty solid explanation. So our mission, if you will, is to dig into that and give everyone a clear picture of their borrowing power.
Exactly. You can think of the TDS ratio as a quick check for lenders. It shows them how much of your income is already going out the door for existing debts.
Okay. So it tells them if you have enough wiggle room for a new payment like a mortgage.
Precisely. It helps them gauge your capacity to handle more debt.
Okay, so the TDS ratio, how do they actually calculate it? What's the basic formula?
Well, fundamentally, it's simple on the surface. You take the sum of all your monthly debt payments, all of them.
Yes, all of them.
And you divide that by your total gross monthly income before taxes.
Got it? Gross income.
Then you multiply by 100, and that gives you the percentage. It's their yardstick for seeing if you can manage the payments.
And you emphasized all payments. It's not just the big stuff then.
Nope. They look at everything you're required to pay each month. Pretty much. So it's broader than just thinking, can I afford this potential new house payment? It's the whole picture.
Exactly. So what specifically gets bundled into that total debt? Let's break that down. Housing costs first.
Sure. So for housing, obviously, the main thing is the potential mortgage payment itself, the principal and interest.
Okay.
But it doesn't stop there. They also add in estimated property taxes for the home, homeowners insurance premiums, and if you're buying a condo or something in an HOA, those association dues count too.
Okay, that makes sense. What about utilities? I saw a mention of that.
Yeah, interestingly, some lenders do actually estimate and include basic utility costs like heat, electricity. Not always, but it's common enough.
Wow. Utilities too. That's more detailed than I might have guessed. So it's the full shebang of keeping the house running.
Can be, yeah. We want a realistic picture. Then you have the non-housing debts.
Okay, what falls under that umbrella?
That's things like your monthly car loan payments, any student loans you're paying.
Student loans, right? Big one for many people.
Definitely. Also minimum payments on your credit cards. Even if you pay more, they often use the minimum required payment.
The minimum payment. Okay.
And then things like child support or alimony payments if those apply. Basically, any regular fixed debt obligation that shows up.
Got it. So they tally up all of that monthly outflow, housing, non-housing, and compare it to your gross income. How does the resulting percentage, the TDS ratio, actually impact getting the loan approved?
Well, it's pretty straightforward. The lower your TDS ratio, generally, the better your chances.
Lower is better. Makes sense.
Yeah, a lower number tells the lender you have more income left over after covering your existing debts, making you seem like less of a risk.
Is there a specific target range lenders look for?
There is. Generally, they like to see it somewhere between, say, 36% and 43%. That's kind of the common window.
36 to 43%. Is there a preferred end of that range?
Oh, absolutely. For mortgages specifically, many lenders really prefer to see that TDS ratio at 36% or even lower. That's kind of the gold standard.
36% or less. And what happens if you're above 43%?
If your TDS goes over 43%, it gets tough. You're much more likely to be denied the mortgage. It's often seen as a hard ceiling by many major lenders.
Okay. So 43% is a real danger zone. Less is definitely more here. Now, you mentioned an example in the material. Maybe walking through that could help solidify this.
Yeah, good idea. The example was someone earning $11,000 gross per month.
$11,000 gross monthly income.
And their total monthly debts added up to $4,225.
And what were those debts specifically?
Let's see. It was broken down as $2,225 for the potential mortgage payment, a $1,000 student loan payment, $350 for a motorcycle loan, and $650 in minimum credit card payments.
Okay, quite a mix there. So how do we get the TDS for that person?
Right? You just take the total debt, that $4,225, divide it by the gross monthly income, the $11,000, and then multiply by 100. So 4,225 or 11,000 dice 100.
Got it. And that comes out to?
It works out to 38.4%.
38.4%. So based on those benchmarks you gave earlier, where does that put this person?
While 38.4% is within that acceptable 36% to 43% range, it's a bit higher than the ideal 36%, but it's comfortably below that 43% upper limit.
So likely approved for the mortgage then.
Yeah, based purely on the TDS, approval is quite probable in that scenario. It hits the mark.
That example really helps clarify it. Now, if someone listening wants to figure this out for themselves, is there an easy way, like using Excel or something?
Absolutely. I actually provided the Excel formula, which is handy.
Oh, great. What is it?
It's just sum debt income x 100. You'd replace debt with your total monthly debt amount and income with your gross monthly income figures.
So for the example, it would be sum 4225 11,000 x 100.
Exactly that. Pop it into a cell, hit enter, and boom, 38.4%. Easy way to check your own numbers.
Nice. That's a practical tip. Now, another term popped up in the research, gross debt service ratio, or GDS. Sounds similar to TDS, but what's the difference?
Well, yeah, GDS. Good question. The key difference is debts included.
TDS, as we've been saying, looks at your total debt load, housing, non-housing, everything.
GDS, on the other hand, only considers your housing-related debts.
Ah, okay. So just the mortgage payment, property taxes, insurance, and maybe those HOA fees.
Exactly. It isolates the cost of shelter. Things like your car payment, student loan, credit cards, they are not part of the GDS calculation.
So GDS is narrower, focused just on the house costs. I think I saw it called the housing expense ratio sometimes.
That's another name for it. Yep. And you might even hear brokers talk about Housing 1 and Housing 2.
Housing 1 and 2?
Yeah, sometimes GDS is called Housing 1 and TDS is Housing 2, just an industry shorthand.
Really interesting. So GDS is mainly for mortgages too?
Primarily, yes. It's a key metric specifically in mortgage underwriting, and for GDS, lenders usually want to see that ratio at 28% or less.
28%. Okay, so another benchmark to keep in mind.
So when you apply for a mortgage, they're looking at both. GDS ideally under 28% for just the housing, and then TDS ideally under 36%, but definitely under 43% for the whole debt picture.
You got it. Those two ratios plus your credit score are like the big three pillars of mortgage underwriting.
Makes sense. Now, you mentioned that 43% TDS is often a hard limit. Are there any exceptions? Could someone get approved with a slightly higher TDS? The material mentioned special considerations.
Yes, there can be some flexibility in certain situations. One thing mentioned was smaller lenders.
Smaller lenders? How small?
Specifically those with under $2 billion in assets who haven't done a huge volume of mortgages, like under 500 in the past year.
Okay. And what can they do differently?
They might have the ability to approve what's called a qualified mortgage, even if the borrower's TDS is a bit over that 43% mark. They sometimes have a little more discretion.
Interesting. So who you borrow from might actually matter there. What else could help someone with the borderline TDS?
Well, your overall financial picture always matters. A really strong credit history and a high credit score definitely helps because that shows you managed debt well historically.
Exactly. It builds confidence. Also, having significant savings or being able to make a larger down payment is a big plus.
Reduces the lender's risk.
Right? Less money borrowed, less risk. And sometimes just having a long-standing positive relationship with your bank or credit union might play a small role too. They know you.
So while the ratios are critical, they aren't always the absolute only thing. There's sometimes a bit of a holistic review in some cases.
Yes, especially with those smaller lenders or if you have strong compensating factors like a big down payment. But for most people, hitting those TDS, GDS benchmarks is crucial.
Got it. Okay. Just to really nail this down, can we quickly recap the TDS calculation one more time, the basic formula?
Sure thing. It's your total monthly debt payments, all of them. Mortgage, loans, credit cards, everything divided by your gross monthly income before taxes. Then multiply by 100.
Perfect. And the Excel shortcut again was sum debt income x 100.
Exactly.
And the magic number, the ideal TDS target for a mortgage?
You really want to aim for 36% or lower if possible. While up to 43% might be acceptable, sometimes 36% is the sweet spot lenders love to see.
Makes sense. And the absolute core difference between TDS and GDS one last time.
Super simple. GDS, housing debts only. TDS, total debts, including housing and everything else.
GDS is narrow, TDS is wide.
You got it. TDS gives that complete view of your debt obligations relative to your income.
Okay, this has been incredibly helpful. So the TDS ratio is really fundamental for anyone thinking about borrowing, especially for a house. It shows how much capacity you truly have.
Exactly. And understanding your specific TDS number gives you power. It helps you see where you stand from a lender's perspective.
So, for everyone listening, maybe take a few minutes after this. Think about your own finances. What are your total monthly debt payments? Add them up, and what's your gross monthly income? Do that quick calculation. Maybe even use that Excel tip. See what your TDS ratio looks like.
It's a really revealing exercise. It can show you, maybe where you might need to make some changes if you're planning to borrow in the future.
Absolutely. It helps you assess your own readiness. So, here's something to think about. Considering how lenders scrutinize this whole debt picture, your TDS, what adjustments, maybe small, maybe large, could you potentially make to give yourself more financial flexibility and ultimately boost your borrowing power down the road?
That's a great question to mull over. Really thinking strategically